grow. Our memories are incredibly short. I have bad news, and I have good news. The investment you made last week has gone down by 50%. But the good news is, you want to share? You can now buy more units at half the price they were a week ago. I think Mr. Chairman was just saying that today. Dollar cost averaging in a crisis. Let's look two quick examples. Investment at $1, that's 100,000 units. That's terribly simplistic. 66,000 units at $1.50. That's market going up nicely. Thank you very much. Units grow to $2. Therefore, the value is units times value, 332,000. Let's do the math. Case 2. The market plummets. You buy last week, it plummets this week, and it rises next week. We wish. So $1 per unit, you've got your 100,000, but your 100,000 next investment buys 200,000 units. Units grow to $2, you got 600,000. So in the market of negativity, there is always the positivity, but we tend to the negativity. Remember, this is the simple rule, that it's not only the price of units that determines the value of your investment. It's the number of units times the price that determines the value. And that's a key factor to educate your customers on. I once trained a builder, a construction worker in London who wanted to go into investment linking for the first time. And I showed him the Financial Times, which I was very proud to carry, and showed him how to calculate the price of his units and therefore the value of his investment. He was so delighted, he went around the whole construction yard showing everybody what he had learned about how to calculate units. And I think he was the only builder in London at the time buying an FT every morning, Financial Times. Looking at the linear graph Dow, and this is only 1901, kind of post-wars up to 2006. Similar to Jamie's graphs. But this one, you can see the line all the way on the bottom at 0 there, which doesn't tell us a lot of information about growth in that period. You can't see it. Except we know things were happening because, look, it's a straight line or a little squiggle around 1930. Yet we're told there was an absolute crisis. Yeah? So let's have a look at it on a different form of graph. This is called a log graph. So the first row is hundreds, second row, each segment is thousands, then 10,000s. Now, although this one only goes to 2006, you can see it's at around 9,000, and that's kind of where it is again today. Yeah? So it's not the end of the world in relation to the market and the market slumps. I know the basic fundamentals haven't been looking good. But sometimes, to get rid of the stress, we maybe need to go back and look at a little bit of history and say, hey, this has happened before, and there's always a way out of it. But, as Jamie said, maybe it'll take a little bit longer. So if we look at some distributions of growth rates over a 79-year period, there were no years with losses greater than 50%. Almost, if we go on to 2009. And 5 years with losses between 50% and 20%. Conclusions from the graph. Stock market returns are negative about 20 or 25% of the 79 years. So about 75% of the years have positive returns. That's not bad, is it? In terms of, let's be optimistic. There are relatively few bars with less than 0% return, but quite a few above 0%, in fact, quite a lot. Most of the time, about 45 of the 79 years, the returns have been between 0 and 30%. Now, I think in sales presentations and putting the message across, we have to have a balanced message. And I know we have to be careful with that. But at the same time, we can sell the benefits as well as sell the downsides so that people understand both sides of the equation. Once they're educated to risk, The stress is off you. So what's not to like? It looks like when you lose a little, but when you gain a lot. How about that one? This is just a short period, 6th of October to 5th of October. AIG share price. Bit scary, yeah? In one equity showing exactly what the fears of everybody in the market would be. But yet, sure there was a big downside, but there was kind of a correspondingly big upside as well. Yeah? Who'd have believed it when the doom and gloom about AIG was being talked about? What's the future? Who knows? But that kind of growth rate is dramatic in shares, but that's not maybe what people want. Like that graph is almost like skiing down a mountain, isn't it? And then climbing back up again at a very fast rate. This one is a bit more about unit trusts are a perfect method of investment for those investors who want to minimize stress. It also helps the customer to understand how unit trusts work both in the good times and the not so good times. And that will also limit your stress. And I think the chairman suggested that in the introduction today, that sometimes if we are over-enthusiastic in the representations we make in the optimistic and the good times, when we know the graphs always will turn down at some stage or other. It just depends when your person buys in and when they buy out, and how many times they bought will decide whether that was a good decision or not. But if you've been over-enthusiastic about growth rates, the stress is on you. They're going to be knocking at your door. But if they have a balanced view and are willing to accept the up, hey, it's good when you get the upside. Hey, you've also got to accept responsibility for the downside, as long as they're told. Top 2 expectations consumers have of their advisors. And this came from some research that was conducted by LIMRA recently, the Life Insurance Marketing Research Association. They said, the expectations that your customers have of you is, please stay in communication. And please provide honest updates. If you got to tell some bad news, tell the bad news. But hey, in your companies and behind you, you have some extremely highly paid, extremely experienced market analysts and investment geniuses who are there to produce for you and your client the best returns they can, whatever market is thrown at them every day. That's their whole job in life, is to grow those funds and grow those investments. And provide those honest updates in a way that they will feel happy that you're giving them some regular updates. The result would be 90% felt reassured that the agent or the consultant was back in touch simply because they were getting real information. The lack of answering of telephone calls or the lack of response to letters or inquiries only leads to uncertainty and fear and stress in the customer. So despite losses, they felt reassured. That's key for you to remember. 74 even referred prospects. Because even in the down market, there are opportunities in dollar cost averaging. When you looked at some of the downturns, you could see the asset base behind some of these was going to act as a handbrake and give that asset an opportunity to pick up again at some time in the future. Good quality assets. Top 4 actions that they expected was check the account balance, just give them an update. Change the asset allocation, if that is the advice of the fund managers and the recommendations, at least they're given the opportunity. It might be to increase their investment if they have spare liquidity, and it might be an option, depending on personal circumstances, to withdraw from the account. Sometimes it is appropriate and a tough decision to make. So, proactive stress reduction in terms of market conditions for us as a group of people would be, hey, there's no better time when investors want to talk with you more than in this time. And it's a great time for relationship building for the future and grow the potential of your future business. A crisis is the best opportunity to strengthen relationships with your investors.